how Islamic insurance, or Takaful, operates. Let us unpack this in today's episode.
We all feel it, don't we? That basic human need to manage risk. We look for financial safety nets, the life insurance covering the house, protecting the car. We pool risk together because, well, a personal disaster shouldn't mean total financial wipeout.
Right.
But what if the whole basis for that safety net wasn't about maximizing profit, but purely about, well, mutual help?
And that brings us straight to Takaful. It's often called Islamic mutual insurance. The sources we looked at are really clear on this. Takaful is built on shared responsibility, mutual cooperation, and it explicitly rejects making profit from the risk itself. That's the crucial part.
So it's not just tweaking conventional insurance.
No, not at all. It's framed as a fundamentally different kind of financial agreement.
Okay. So our mission for this deep dive is to really unpack that blueprint. We need to get past the simple definitions, understand the principles behind why it's structured this way, and then, crucially, show you exactly how this model works in practice. We want you to see the actual financial difference between being a customer in a standard system versus a participant in Takaful.
Yeah, we're going to walk through the mechanics, the sort of philosophy, and the numbers. It's an old model, actually, but one offering a pretty modern alternative to how we share risk.
Okay, so let's start at the beginning. Takaful exists because conventional insurance often includes things that clash with basic Islamic commercial law. You mentioned three key ideas Takaful avoids: Gharar, Maysir, and Riba. Let's start with Gharar. What is that exactly? Excessive uncertainty.
Gharar is, a really central concept. It basically refers to transactions that have too much risk or ambiguity or uncertainty, things that could lead to one party losing out unfairly. In standard insurance, you pay your premium, right? But you have no idea if you'll ever get anything back.
Right.
And the insurer doesn't really know for sure what they'll end up paying out either. The whole contract can be quite opaque. The customer often doesn't see the real math behind it or how the risk is actually distributed.
So if I pay, say, $1,000 for my car insurance and I don't have any accidents that year, I've just lost $1,000 straight up. The insurer made money from the uncertainty of whether I'd crash or not. That does feel a bit unbalanced, doesn't it?
Exactly. That's the kind of Gharar Takaful tries to reduce through its structure. It aims for more transparency by changing the deal from selling risk protection to making a kind of collective donation to a shared pool. The participant knows exactly where their money is going. It's going into a fund that belongs to all the participants together.
Okay, I see. And what about Maysir and Riba? We usually hear Maysir translated as gambling. How does something like conventional insurance, which feels like a predictable product, fit into that idea of gambling?
Well, the gambling aspect is subtle, maybe, but it's seen as significant. In conventional insurance, the contract can look a bit like speculation. You're essentially betting a small amount your premium against the chance of winning a large amount, the payout, if something bad happens. And the insurance company is, in effect, taking the other side of that bet. Takaful removes that element because your contribution isn't a bet. It's treated as a mutual donation, a tabaru or gift. It's intended purely to help others in that shared pool.
That structural difference again. It changes the nature of the payment. And then there's Riba, the ban on interest. That must affect quite a lot, like how the funds are invested.
Oh, absolutely. It's huge. The money in that shared pool, it can't be invested in things that generate interest, Riba, or in businesses involved in activities considered non-compliant, like alcohol or pork, for example. So the investment strategy for the fund itself has to be ethically sound, Sharia compliant. It usually involves things like profit-sharing arrangements, known as mutharaba or wakala, rather than, say, interest-bearing bonds.
Okay. So avoiding these three things, the excessive uncertainty, Gharar, the speculation or gambling, Maysir, and the interest, Riba. That's what leads to that interesting role reversal you mentioned earlier.
Precisely. That's the biggest structural outcome. The participants effectively become the owners of the system. In standard insurance, you buy coverage from a separate company. In Takaful, the members are both the insurers and the insured all at the same time.
Right.
Your contribution gets pooled with everyone else's, and together you create the shared community shield. The risk is managed among the participants.
Okay, that makes philosophical sense. But practically speaking,
Yeah.
someone still needs to manage this big pot of money, right?
Yeah.
You need people to process claims, handle regulations, do the admin. If the participants own the fund, how does the actual Takaful company, the operator, fit into this? And how do they make money? Because they're a business.
Yes. And that's the absolute key difference. It's where the financial model really diverges. The Takaf operator, the company running the show, manages the fund. They do all the admin, the underwriting, the investment management, all that. But, and this is so important, their only profit from the actual operation comes from a set management fee. Yes, often it's a percentage of the total contributions paid up front. They get paid for their services for managing everything.
So they're paid to manage the fund, not to take on the risk itself.
Exactly. They're acting like a steward or an agent. In Islamic finance terms, they're often called a wakil. Their profit doesn't come from the underwriting results. So if they collect, say, $500,000 in contributions and only end up paying out $100,000 in claims, they don't just keep that $400,000 difference as profit.
Which is exactly what a conventional insurer would do. Right?
Yeah.
That underwriting profit is their main goal.
It's a core metric for them, yes. But for the Takaf operator, that surplus isn't theirs.
Wow. Okay, that changes the incentives completely. In the standard model, the insurer wants to minimize claim payouts to boost their own profit for shareholders. But if the Takaf operator only gets their management fee anyway, regardless of how many claims are paid, what motivates them to be efficient or careful?
Their incentive shifts. It moves away from short-term underwriting profit towards building long-term trust and, well, growth. Think about it. If the operator manages the fund badly, or if claims shoot up because they weren't careful about who they let in, the shared pool suffers. And since that pool belongs to the members, the operator's real goal has to be keeping that fund stable and ideally generating a surplus.
Lies surplus.
Because a surplus keeps the participants happy. Happy participants stick around, maybe tell their friends. That means consistent business, which means consistent management fees for the operator year after year. Their long-term survival depends on being seen as really good, trustworthy managers of the members' money.
So the pressure is still there, but it comes from a different direction. Instead of shareholders demanding maximum profit from taking risk, it's the participants who implicitly pressure them to run things efficiently, keep costs down, and protect the mutual fund.
That's a great way to put it. The pressure is fundamentally reversed. And this focus on transparency, on minimizing costs, it's probably best seen with an example. Let's use that Takaf scenario from the source material. It makes it really clear.
Okay, yeah. Let's put some numbers on these ideas. Abstract concepts meet cash flow. So setting the scene.
Yeah.
We have 1,000 car owners who need coverage.
Right. And each of them makes a cooperative contribution. Remember, it's like a donation of $500 for the year. That goes into the shared Takaf fund. So simple math, 1,000 times $500. That immediately creates a total pool of $500,000.
$500,000. That's the community's shared shield, as you called it.
Exactly.
Okay, so the year goes by, accidents happen. This is the risk part playing out.
Yep. Let's say over the course of the year, 50 of those 1,000 members have accidents that need payouts. The total cost to repair those 50 cars paid out directly from that shared $500,000 pool comes to $250,000.
Okay, so half the funds has been used for its main purpose, helping members in need.
Yeah.
But we still have the operator to pay for their work, right? The example gave a specific fee.
Correct. The operator has their pre-agreed management fee for running the scheme, processing those 50 claims, managing the investment, all that stuff. In our example, that fixed fee is $50,000 for the year.
Right. Okay, let's do the final tally then. We started with $500,000 from contributions. We paid out $250,000 in claims. And we pay the operator their $50,000 fee. So $500,000 minus $250,000 minus $50,000. That leaves $200,000.
$200,000 left over. That's the surplus. It's the money remaining because the community's actual claims were lower than what they contributed, even after paying the manager. And the surplus, this $200,000, is where you really see the structural difference kick in. It has to be handled according to that principle of mutuality.
Because in the conventional insurance world, that $200K surplus, that's basically profit. After taxes, it would boost the company's bottom line, maybe go towards shareholder dividends. But here,
fundamentally different. That $200,000 surplus is not income for the operator. It can't be. Because the original funds belong to the participants, any surplus generated from those funds also belong to them. The core principle demands that this money goes back to the participants.
how does that actually happen? Do all 1,000 car owners just get a check in the mail for $200 each? $200,000 divided by 1,000 members.
It can happen in a couple of main ways, generally. One option is exactly that, a direct cash refund or distribution to every single participant. Importantly, that includes people who didn't make a claim because everyone contributed to the pool's success.
Okay.
The other common method is to use that surplus to reduce the contribution amount for the next year. So instead of paying $500 again, maybe next year your contribution is only $300 because of the surplus return. It lowers your future cost.
Ah, okay. That really is the aha moment for someone in the system, isn't it? If the group, the community, does well managing its risk together and the operator is efficient, the actual cost of your protection can go down over time.
Yeah.
It shifts insurance from being this fixed cost where you feel like you lose out if you don't claim
Mhm.
to being more like a variable cost where good collective behavior actually saves everyone money.
It really does. And it can create this interesting sort of shared responsibility dynamic, almost a behavioral economics aspect. If you know that if the group manages risk poorly, maybe there's lots of fraud or just general carelessness leading to more accidents, that it will directly eat into the surplus you might get back. Well, it introduces a kind of social pressure for everyone to be a bit more mindful, perhaps.
That's a subtle point, but yeah, potentially powerful. It just reinforces that core idea, doesn't it? Takaful is about we all chip in to help each other out when needed.
Hmm.
And it's supported by this transparent, accountable, Sharia-compliant structure where some outside company isn't profiting from our collective risk.
And think about the pressure on the operator again. That operational excellence has to be intense. A conventional insurer, if their admin costs go up a bit, well, maybe they had a really profitable year on the underwriting side, low claims, so it balances out.
Right, they have that buffer.
But if your only income is that fixed management fee, you simply cannot afford waste. You can't let costs creep up unnecessarily. The operator's own business success is tied directly to being super efficient, maximizing that fee's profitability for them, while also making sure the fund stays healthy and generates that surplus to keep the members happy.
It forces them to be good stewards.
It has to. Every dollar they save on running the operation validates their role and helps ensure the members see value, potentially in the form of that surplus.
Okay, that's a really clear picture. So, summing it up, Takaful is fundamentally a mutual system. Members share the risk collectively, the operator gets paid a specific fee just for managing things, and the clincher, any leftover surplus, goes back to the members, keeping the focus squarely on community support and long-term stability, not on generating external profit from the risk itself.
Nicely put. And maybe just one final thought to leave you with, connecting this back to the bigger business picture. Since that Takaful operator only makes money from the management fee, not from underwriting profit, does that structure maybe make them inherently better at long-term risk assessment? Think about it. Does the pressure to return the surplus, rather than just keeping it, push them harder to invest in things that genuinely reduce the community's overall risk? You know, things like promoting safety, using technology for better prevention, rather than just focusing on pricing the risk correctly or shifting it off to reinsurers. The way the incentives are aligned here, it really changes the whole business calculation. That's something worth mulling over, I think.